Welcome to CFA Society New York's podcast, Compound Insights. I'm your host, Rob Rowan. Today, we're talking about inflation with someone who you may have seen on one of our webinars earlier this year, Darnell Azeez. Darnell Azeez is CFA, heads the value equity team, and works on dividend strategies at Lord Abbett. He was previously a portfolio manager on Lord Abbett's taxable fixed income team, and he has also been an equity analyst. Darnell got his BA from Lafayette. Today, for this conversation, we are going to be talking about inflation in the U.S. and concerning U.S. investments, just so we get the frame right. So, Darnell, thank you for being here.
Thank you for having me.
I guess the best place to start is, what is your outlook for inflation now that we're here at the end of January and everything's kind of up in the air?
Yeah, great question, Rob, and certainly the main question that everyone in the market is grappling with, including myself and my colleagues here. I think when I think about inflation, it's really longer term inflation and near term inflation. I think what has become obvious is that the transitory inflation, as defined by the Fed, has been a longer period of transitory than what I think the market and the Fed expected as of last year. My personal feelings are I had been in the transitory camp. I do think that ultimately this powerful burst of inflation will of course moderate from where we are now. The question is, what will the longer term outlook be? Will it be above the sort of 2% level that the Fed has been unable to achieve for a number of years, for over a decade now, or is it structurally higher than that? I think there's arguments on both sides, but I guess I look at it in two different ways. So if you think about what's happening right now, what's pushing inflation higher, the biggest thing that sticks out to me, and I said this even last year when the topic was coming up, is wages. I think for the stickiness of inflation to last, we have to look very, very closely at wages. And right now, we're at full employment by most measures beyond full employment. You have a very powerful labor market. You have a number of people that have left the labor market potentially permanently, right? The number of retirees. And that is putting a lot of upward pressure on wages because there's a scarcity of labor out there. And you see that throughout the economy. The question will be, will that reverse, right? Will potentially some of the healthcare aspects, so as the Omicron or COVID wave subsides, will you get some people re-entering the workforce, which potentially dampen wages? Also, what you may see as some of the stimulus rolls off, the fiscal stimulus that was given to households, as that rolls off, people may re-enter the workforce as that money sort of dries out, and that could potentially dampen wages a bit. But ultimately, that is one area that is running white hot and is potential to make the inflation stickier than maybe people expect. The other area I'll point to is in housing. We've been very, very positive on the housing market for a number of years, and for the same reasons, right? Supply and demand. We had a situation where we underbuilt homes going back to the financial crisis. You have a massive population of millennials that are hitting an age where they were naturally moving out of cities and into suburbs if they have children and look for housing. And so you had increased supply and not enough demand. As a result, you had home prices increase. And that took a rather violent turn positively during COVID, as there was the deurbanization trend, work from home, and people continued to move out of cities, and the supply was still not there. And so housing prices skyrocketed, and that is probably still sticky. And so that will drive inflation a bit higher, I think, structurally. And then the last area, which will be probably the most volatile of the three that I'll talk about on the upswing, is energy. Energy, again, we have supply and demand. So you see oil prices now, I think we're close to $90 a barrel. And what we've seen is a tremendous period of underinvestment in the energy patch as a result of companies losing money, over drilling within the shale, and we have the energy markets more supply and demand balance. And so And on top of that, as demand comes back, from the COVID lockdowns, not enough supply, you see upward pressure on oil prices. Layer onto this the energy transition that we've had globally, right? Where, yeah, I understand we want to move away, we want to decarbonize the world for all the reasons that we all appreciate, but in that transition is in the near term is absolutely inflationary, and you've seen that upward pressure on energy prices. Now that could reverse. You can have a demand slow down, so on and so forth. So I think those three areas are the ones that I look at where you could say, okay, we need to watch these things and see how long they last and how powerful a force they are to become afraid of inflation. As far as the supply chain aspects of it, I think that will clearly moderate. I think it's already in somewhat moderating. But those would be the reasons that I would look at. So, okay, sir.
Yeah, well, you said quite a few interesting things there. Let me just back up a few on a few of them. So, do you think that there's potential that the increase in the cost of living will coax people back to work who may have thought they were tired or taking sort of a bigger break? Yeah. And that would lower wages, which would lower inflation. Do you think that dynamic is a possibility?
It could be, right? So often, so often in things like the cure for high prices is high prices, right? They always say in the energy market. So, you have a tremendous amount of wealth that's been built, right? So maybe people have been allowed to retire, and so you think about just an equity market correction, right? So some of that comes out, right? And you think about interest rates going higher and the negative effects that may have on fixed income portfolios, right? So maybe that causes people to re-enter the workforce. But what I think more so than that aspect of it, I think it's the removal of this fiscal stimulus that's been given to more on the low end. As that has run off, people may be forced back into the workforce, and maybe that maybe that's more of a right-wing fantasy, but I think there may be some truth to that. So that's one aspect, but also the health aspect to people that may just say, you know what, I'm uncomfortable going into some of these frontline, they'll go back into a hotel, right? Because services inflation is where you're really probably going to see a lot of that. So a hotel worker may, they have a sick parent or something like that, and then they don't want to necessarily get back into the labor force right now until they feel better. So I think a combination of COVID receding and some of the extraordinary stimulus from a fiscal standpoint rolling out may allow some folks to re-enter the labor market to maybe allow labor supply to pick up, and maybe put some downward pressure on wages. And plus, and the other thing, sorry, to go on a rant, but the last aspect I would point to is just the base effects, clearly, right? I mean, so the base effects will moderate as just from a year-over-year standpoint, and growth will moderate. So you'll have less growth just from higher base effect as we go down from, call it whatever, 5.5%, 6% GDP to something close to 3.5% this year. And you have a Fed who is a Fed chairman and a Federal Reserve that's been very clear that they are very focused on reducing inflation. They, without even raising rates one time yet, they've caused about 70 basis points of increase on the short end on the 2-year just from talk from November. So they've somewhat just been successful in jawboning some tightening in financial conditions, which I think is appropriate. So
yeah, it was interesting to see that. The impact on the overall market did seem to be more substantial than, say, what the actual impact of an eighth or a quarter might be from historic lows.
Yeah, it's fascinating because, I mean, what I tend to look at, what fascinates me is really the long end, right? So as I look today, I see 178 on the 10-year. I believe if we go back to the end of 2018, the last time where, the Fed was kind of aggressive and saying that they were going to, raise rates and slow things down, and that caused a quick 20% correction in the equity markets. That was at a time where you had, the 10-year probably was, I would say maybe 2.5 to 3. Right? You have a much lower 10-year. You have an even tighter labor market. You have stronger GDP growth, and you have rates lower. Right. So, but even if you didn't have, if you needed to take away the supply chain and COVID, they probably should be raising rates anyways. Right. And so the combination of balance sheet runoff and rate increase, even if you didn't have the inflation, I would say they'd probably be inclined to raise rates in this environment. So I think the market is struggling a little bit with the adjustment, but I think the adjustment is absolutely necessary. Right. I mean, we're no longer in a position where we need extraordinary measures. We've recovered. There's absolutely no reason that the Fed should be supporting the housing market at this point.
Hmm.
And so I think it's a normalization process that's causing a bit of pain and causing a bit of repricing of risk, certainly longer duration, more speculative assets of the market. And I don't think the Fed is necessarily too unhappy with that, right? I mean, I don't think it's unhappy with NFTs crashing a bit, or some of the air coming out of some of the more speculative parts of the market. And in some respects, they're doing the right thing, and I think they're doing a good job. So,
Yeah. Do you think that the rise in the housing market, which raises the concerns of some of us who've been in the markets for a while, is reaching an unaffordable stage, or someplace where an audacious amount of borrowing might be required to simply get the house?
yeah, that's so you think about measures of affordability, and that's a combination of sort of rates and home price appreciation. It's difficult to it's difficult to say. I mean, I feel like I've been saying this for years, right? I mean, you probably consider 5 years, and anyone that tried to buy a house in probably the last 10 years, probably kicking themselves for not pulling the trigger. So I think it is particularly unaffordable or inaffordable, excuse me. But I think that's a function of a lack of supply of affordable housing, and I think that is a function of potentially just a lack of building from home builders, maybe a lack of labor supply. That's been an issue for builders for a number of years. I think they've just been slow to adjust to the booming of demand that we've had. So, affordability, it really depends, right? What's affordable to a millionaire in New York versus, versus someone making a different wage in a different part of the country. So it really is local. And I've heard people make the affordability argument in both directions, but mortgage rates are still relatively low. And I think lending standards are not loose, not at all as loose as they were, certainly not in the housing bubble. And so it's a hard question, I guess, to answer, because I know so many folks are looking for housing, but there's just no supply.
Right. Right. And the other thing I did want to circle back to was you were talking a little bit about the supply chain issues. Now, I know that it seems like some boats have started moving some places, but the Baltic Dry Index, which was low for basically the entire life of my son, it was basically zero, did kick up and has only retracted a little bit. So, what indicators do you look at to measure the impact of the not only where that issue is, but how you measure it in your portfolios?
Yeah, that's good question. So I tend to, as a portfolio manager and our analyst, we look at a lot of it at a company level, right?
Mm-hmm.
And so we try to understand, and this is sort of, maybe we'll get into portfolio positioning, but, and you can see it today in Apple's results, right? I mean, a lot of the better companies are able to manage supply chains to an extent better than some others, right? I mean, there's some issues that can't be fixed. Maybe semiconductors has been a big bottleneck, and auto, so on and so forth. So, it really depends on the market. It depends on the company, and so we do take it on a case by case basis. And it's sometimes it's difficult to disaggregate. Is the company really having supply chain problems, or are they using it as an excuse to miss a quarter, right? Because companies, maybe in the same industry, one's having supply chain problems, the other one isn't. Is that a true supply chain problem, or is it an issue with the logistics of the company, or how they're managing the supply chain? So I would just say, I think naturally we know that supply chain will normalize at some point, right? I mean, we know that this is a big impact from COVID. We understand that, a bunch of people not working because of COVID, and people calling out sick, et cetera. We know eventually that will normalize. Even if there is another wave, potentially each wave will probably have less impact than the next. And eventually we'll get to a point where supply chains will ease. And you may, on the other side of that, end up having a glut which may actually be disinflationary in the end. But supply chain, I don't know if it's, I think most people are saying, middle of this year, but at some point I think that will normalize, and I think it already has.
Okay, so let's take that as a leaping off point to talk about how you're positioning your portfolios to manage the near-term inflation and the other issues the other risks that you're seeing in the market right now. So pick a subsector, any
Yeah,
subsector.
yeah. I mean, I think broadly, I'll talk in broad strokes, but one thing that we've been hyper focused on, really, I want to say, early to mid last year was really quality. Once you got out of that sort of massive beta bounce that you had post vaccine, where strong cyclicals really start to outperform that sort of rising tide lifts all boats that you always see coming out of a deep recession. Markets really rewarding high beta, really rewarding companies that a little bit riskier on the scale that didn't go out of business. That we really started to see that moderate as we got into the middle of the year. The market started discounting lower growth globally and being a little bit more discerning towards quality. So when we think about quality, companies that have a sustainable competitive advantage, right? Companies that have a strong business model where they can navigate supply chain, right? Companies that can pass through, most importantly, probably pass through cost increases to their end customers, right? I mean, so it kind of goes back to investing 101, right? Who has price elasticity, right? Who can really pass through cost increases to their end customers to maintain their margins, right? I mean, that's all a function of your underlying business. And then lastly, ultimately, who's got the balance sheet, right? Who's got the balance sheet strength to buy back stock as the market kind of goes down? Who's got the ability to return money to shareholders via dividends, right? If you think about a world we're trapped in low interest rates, right? I mean, a world starved for yield, right? The ability to get yield or offer income, offer your equity investments is increasingly important. It's a scarcity value to that we think are important. So we think strong companies, strong fundamentals, real business models, real earnings, strong balance sheets, and shareholder friendly practices are where we want to be at this part of the economic cycle. Certainly. And so, the first half of it was the beta of sort of low quality rallying early, which we think petered out. But then now, as we enter this stage of the economy where you have inflation, but you also have a Fed that is now removing the punch bowl, right? So they're draining liquidity out of the system. They're raising rates. So what happens then, right? That moves the speculative areas of the market. That's the super high valuation names that don't have earnings, right? These are the more dicier areas of the economy where these things have come down. They've come down already, and maybe there's room to go. Maybe they will bounce, but ultimately, I think that playbook is less impressive now as you go from if you go from QE to QT, I think even more so now you want to zero in on quality as opposed to either speculative beta or speculative growth.
Well, let me ask a question related to that then. It has seemed that there has been an oligopolization of some industries in the U.S. There are how many cell phone service companies now? How many airlines? How many rental companies? Are there more of those opportunities to find companies with that elasticity you were mentioning? Do you think there are more of them now? And do you watch what might happen with regulation of those organizations down the road?
Yeah, good question. I don't think there's more. I think there's less, and I think that's where there's opportunity because I think there's a scarcity value to those names, and I think the railroads, right? I mean, that's kind of a natural monopoly, right? And so I think those are the areas that you necessarily want to be in. There may be a regulatory risk, and certainly when you think about large tech, that's something that they talk about quite a bit as what may ultimately hurt them. But natural monopolies are beautiful things, and it's going to be difficult and it's something we'll watch, right? It's something that we'll watch. But I still think those are the businesses that are, from a fundamental standpoint, or where you want to be. There's always going to be some regulatory risk. We'll see. I don't think we're able to go down the path of the Chinese. Let's hope not. But that's certainly always out there. What you do have with these companies and the risk you see, and you start to see some of this in payments, is the risk to disruption, right? And so like the risk here is when you have these natural monopolies out there, then you have these upstart companies that have cool new technology that may ultimately disrupt these companies and come in. But that's the issue now. It's funny because now those companies have gotten funded, tons of private money, easy, seal liquidity. But now as that's being withdrawn, it makes that story a little bit more difficult, right? Just take Robinhood, right? For instance,
right.
stock here, right? We don't own it, full disclosure.
Right.
As that comes down, right, that's supposed to disintermediate some of the traditional, brokerages. But like that, as we move into a quantitative tightening cycle, the disruption story, maybe some of the heat comes out of that a little bit. And so you go back to like, all right, well, who's actually making money? Who's in a good market position? Who's not going to maybe be disrupted 5 to 10 years from now? But maybe they'll end up disrupting themselves, or maybe they'll be opportunistic and actually buy some of these companies that have now come off the boil and incorporate that technology into their own business models, because that's what great companies do. That, right? They disrupt themselves, or what you say, you want to cannibalize yourself before
Right.
it's ready for you.
Right. Yeah, I couldn't tell whether you're going to mention Robinhood or Peloton. Was the way we're going along there. Let's come back to the sort of regulatory part. As the Fed takes steps that you just outlined here, and perhaps takes more of them, do you think that there is a risk that the Fed could overcorrect for inflation?
I think so. But what I will say is what I've been impressed with, and boy, I always think, I don't know if the hardest job is being president of the United States or Fed president. Like
Fed president by far.
I mean, they never. They get such a bum raps, like they can't do anything right. But I will say, I think this Powell has shown a tremendous amount of mental flexibility and humility in reversing course. And I think back to the 2018 episode where you had that quick correction and he quickly sort of took his foot off the gas. I think he may have learned from that, but they could potentially overcorrect. I do think that the structural disinflationary forces that we've had in the world have not gone away, right? You have still poor demographics globally. You include in China increasingly where birth rates are low. You have a tremendous amount of debt globally, which I think is a disinflationary force. Technology continues to be a disinflationary force, and some of the short-term inflationary pressures that we have will clearly abate, though I'm watching wages closely. So I think the Fed could potentially over-tighten. I think you're not getting a signal on the long end. You're not seeing the move up in the long end that you would expect to see with the inflationary prints that we're putting in. So either the long end of the bond market is not buying it, or is this just a tremendous amount of demand for yield globally that is holding down long rates? So, does the Fed continue to push hard on the short end and risk inverting the yield curve? I think, it depends on the inflationary market. So I guess that there's always a risk. But right now, I think the risk that the market sees and the Fed sees is the risk is being too slow and being behind the curve, right? I mean, raising rates for the right reasons is absolutely the right thing to do. And I think it is the right thing to do. Like I said, even if we didn't have this inflationary problem right now, even if it is short term, I think they probably should be raising rates, and they probably should be at least, doing some sort of quantitative tightening, or just removing this extraordinary support that they gave the market, which was needed in 2020. It's just a different market environment, and that's what the Fed's job is, to be the adult in the room. And if it takes the air out of some risk assets, that's fine. If it takes the air out of the overall economy, that's probably not fine. But I think, but right now the risk of the risk of what could really hurt the economy is probably overheating and inflation, and they're doing the right thing in that regard. And there's always a risk to policy ever, but right now, kind of seems silly not to be doing something.
Right. You bring up a good point that we would probably see this at the long end first. Right. But you also bring up a good point about that view being slightly mistaken by the search for yield. Just look at some of the relatively weak European governments that issued sovereign bonds. And the rates that they were paying were exceptionally low for the disaster that some of their economies are. So there's a lot of aberration in the market like that. Where else might you see that, if not the long end of the bond, the long end? Are there other areas where you would look for it in other measures
to see if
the Fed is overcorrecting?
Yeah, I mean, Yeah, I mean, I think, you always look at housing, right? You always look at housing to see if that starts to crack, and you start to see, affordability measures, but that's probably tied in with long end rates too, right? I mean, but it's, I think if the economy is starting to slow down too much, if employment is starting to, jobless claims is always a great leading indicator for everyone. If those begin to spike, and you're starting to see it really starting to impact the real economy. I think you would start worrying. 10% correction in the equity market, I don't think is anything. I think that's completely meaningless. So I don't know. It's a mosaic, right? It's like, what's noise and what's signal is kind of the art of this job, and some things you think are don't seem to make sense, currency markets, et cetera, right? And maybe the dollar strengthens too much, and you have that, but it's a global market, right? You have the Chinese actually easing, right? They're their economy now that's easing. So that's, what they do would be interesting, right? If they ease so much that ends up pushing, industrial metals higher and pushing commodity prices higher, right? That could be something else. So there's so many of these cross currents, right? But I still sort of fall back on, I do feel like short term positive inflation, longer term, the disinflationary forces, I don't know that those have changed so dramatically to say that we're going to be running above trend inflation for a number of years. But, could certainly be wrong. And the global financial crisis changed a lot in financial markets, and COVID may have changed a lot in financial markets in ways that, we don't fully understand and won't understand until we look back on.
Yeah, I can tell you, I've been quite wrong. I've been saying we're looking late cycle for about 4 years now. Well, thank you, Darnell. This has been really interesting. I would like to have you back because there are going to be some interesting things that are going to unfold from here. And boy, this could have gone on for a long time. So really appreciate you joining me here. For podcast listeners, and if you heard anything interesting here about China, you do want to tune into our next episode. We're going to be interviewing Lyric Hughes Hale, who just published an excellent piece on the fundamentals in the Chinese market. So if you were interested in some of the things that Darnell was saying, please check in here 1 week from today. Until then, this has been Compound Insights, and I'm your host, Rob Rowan with CFA Society, New York. Goodbye.